you're investing properly and in a sensible way, the chances of complete loss of everything that you put in are probably, almost negligible or almost zero. The real risk for people is actually, possibly not taking enough risk and allowing inflation to eat into their savings and their investments over time.
Hello everybody, I'm Neal Kelly, founder and director of Thomond Asset Management, and today I'm joined by fellow director David O'Neil. Our guest today is Mark Bradley, head of operations for PortfolioMetrix in Ireland. PortfolioMetrix is a global investment business, and our discussions will be on investing for the non-financial person, the person who is currently interested in exploring investing for now and into the future. Welcome to both of you. Thanks for joining us.
Good to be here.
I suppose today our main objective is to offer some guidance to a person, maybe new to investing, new to considering investing, has some assets now they need to set aside for their future, for their future financial needs, I suppose is the main point. And in the world today, everywhere you look, there's a new book on investing, on financial planning, on how to make $1 million, overnight. And I suppose to start the conversation, the best thing is what we start at the beginning and define, and maybe Mark, we might go to you for this, is define what investing is. What does it really mean?
Yeah, so I suppose investing, fundamentally, it's about trying to grow your savings and your wealth over time. And I think it needs to be distinguished from speculation. The two different things. So investing is really, taking a sensible view on how to grow your money patiently over time, versus what often gets confused with that is the whole idea of trying to, maybe get rich quickly or put your money into more speculative assets. Crypto being a recent example, or things like during the Celtic Tiger, the property boom, putting your money into overseas property or whatever. Or then maybe after the crash, putting your money into gold and hoping that it'll increase in value very quickly over time. Investing is the opposite of that, so it's very much about a patient, long-term strategy. Important to think about things in a short, medium, and long-term sense as well. So shorter-term needs, you might avoid investing altogether and just keep your money on deposit in cash, something safe. But your more medium and long-term.
But there are challenges with cash. Cash is, that seems to be people's safety mechanism.
Yeah, a lot of people will default to cash for any, excess money that they have, any, savings or inheritance or windfall that they might receive. But it's not a great long-term strategy. And the reason for that, which most people will be very familiar with over the last couple of years, is inflation. So if we think about how much a cup of coffee costs, 5 years ago, you were looking at maybe $2.50 for a takeaway coffee. Now you might be talking about €4 in some cases. So you've got to really make sure that your money that you have saved today is going to be worth at least as much in the future as it is today, and can get you as many things as it can today. So when we think about long-term investing, compounding is your friend. And what we mean by compounding is allowing your money to grow over time, year in, year out, consistently. And I think it was Albert Einstein described compounding as the eighth wonder of the world.
Yeah, I suppose when you think about recent times, the cost of living crisis, inflation is a real driver there. If you hadn't been, your savings, your investments hadn't been staying ahead of that, you were really kind of losing value in real terms, rather than just,
exactly.
Okay. I suppose, Dave, in your experience, the financial advisor, a person starting out, what are the real challenges they're likely to face when they begin to consider investing? What do they need to think about?
As in a first-time investor?
Yeah, somebody inherits some money and has never really considered investing before. Where are we going? Like, where do they start?
Yeah, I suppose the first thing you'd have to overcome is, as you said already, the speculative investor who listens to the latest trend and so on and so forth. Technically, nearly every investor you meet for the first time has the ethos of buying high and selling low, which is the polar opposite of what you actually should do. So they all want to kind of get in at the top of a craze, like you said, crypto, or back in the day with property. And then the minute things go wrong, they're looking to run to cash, when in actual fact you should be doing the polar opposite. You're trying to teach an investor that, take for instance in the global pandemic, when the market had dropped so suddenly, it was one of the sharpest drops, that was a buying opportunity for long-term investment strategy. And I suppose as a financial advisor, you need to try and start sowing those seeds at the very infancy of their journey. So really, from the point of view of myself, when I start with a client, I start talking about the journey. So we look at the three fundamentals: your risk capacity, how much money do you actually have to invest, or how much money do you think you have to invest, because you have to have a certain amount of reserves and money you can fall back on, and what's your time horizon? What are we looking at here? Is it a 10-year investment or a 15-year investment? And educate him, because he'll be completely uneducated at the time. And then risk tolerance. Risk tolerance is only one part of the overall journey. Risk tolerance tells you what a person's tolerance will be when something goes wrong. But that could happen at the beginning, or that could happen 6 years into the
that in itself is flawed, because when we
always
risk profile a client at the beginning, we'll come to risk profile in a second, it's at a point in time. Yes. It's the journey that matters.
Yes, I agree. I think you need to be, with a client, you need to make sure from the very beginning that he understands what he's going into, and make sure that the investment he's going into is something that he can afford to leave for that length of time. So educating the client and forcing the client in a way to educate himself a little bit, and doing your due diligence on him to make sure that the investment strategy is something, a portion of his overall wealth. You'll never get all your money ahead of inflating. And also, which I always like to do with investing, is you can show a person, realistically manage their expectations. As you said, I think Bitcoin went up by whatever 1,000%. Most people didn't look at Bitcoin until it hit 400, 500, 600% growth.
Until it was in the news.
Yes,
yeah,
absolutely.
I suppose on that point, Mark, the concept of risk versus return. I mean, could you explain maybe how that should, an individual maybe should consider that in terms of his investment decisions? I mean, risk. Our definition of risk as advisors is often not what a consumer, like an investor, a client of ours, thinks risk is.
Yeah, I think commonly people think about risk as maybe, when it comes to investing, the risk of completely losing all the money that you put into something. And I think that risk probably applies more to that kind of speculative stuff that we were talking about earlier on. Like if you're investing properly and in a sensible way, the chances of complete loss of everything that you put in are probably, almost negligible or almost zero. The real risk for people is actually, possibly not taking enough risk and allowing inflation to eat into their savings and their investments.
That's a big line for Dave is always talking to clients about that particular issue.
Yeah, and it probably is the biggest risk out there for people with long-term money, is that, they don't allow it to grow enough, or other risks might be not saving enough, into a thing like a pension, not taking advantage of those tax advantages that are there, and possibly reacting to too much sort of short-term fluctuations in the market. Like, it's almost become a cliche because it's plastered everywhere in financial services literature these days, but, markets may fall as well as rise. And, if we actually do sit down and think about what that means, like that does mean that in the short term markets can go down, but they do recover over time. I mean, pretty much over any time frame, if you give it enough time, markets will recover, and you'll do better by staying invested than panicking and going to cash or whatever,
Yeah, I mean, the problem with that though is like, clients do follow the stock market. There's an app for all of these things now. Yeah. The problem is that's not necessarily what their portfolio is doing. So, picking an index, the S&P 500 falls 20%, 40% during COVID. I mean, our experience would say that most clients with a balanced portfolio wouldn't have experienced anything like that, wouldn't you say?
No, absolutely. Balanced portfolios, I suppose, for most clients, the majority of clients, they will not realistically, with their behavioural betas kicking, tolerate 100% pure equities, unless they're knowledgeable, seasoned investors have been there and done that. So for most clients, to keep them invested and to make sure that they don't do the fundamental biggest mistake, which is crystallize their loss in those periods of down, is to have a balanced portfolio based around that risk tolerance, which isn't the holy grail, but it is hugely important. So you also have to manage them through those periods of times. So, distinguishing between the difference between bonds, what a bond is, you don't have to overcomplicate it, but you do have to explain it. Everybody understands what cash is. Most people want to invest in a cash-like product with an equity return, right? The utopian investment strategy. But we can't have that. So like with the likes of PortfolioMetrix, that's really what their expertise is as well with Mark, is that blended portfolio that gives that diversification. And for all new clients out there, I would 100%, especially when you're starting out with very little experience, a diversified portfolio can give you a fine return, and it can manage those downsides and force you from allowing your behavioral betas kick in and making what we all would agree would be the fundamental biggest mistake, which...
But I mean, the big factor that most investors always forget about, I mean, it's the world we live in, is time.
Yes.
Nobody factors in time anymore when it comes to their investing. They hear too many stories about crypto, and, during COVID, there was a few other ones that kind of made people apparently fortunes, meme stocks, that's the word I was looking for. That's not reality. That's not the world that we actually live in, and they rise and they fall just as quickly, and people are just not able to live that journey. I mean, it's just a fact. Okay, I suppose, in your opinion, Mark, as a beginner investor starting out, here we are, what should an investor look to invest in? I mean, we've talked about things to avoid maybe a little bit there, and having a balanced portfolio. That's all very high end. But when it comes down to, actually transferring money into something, what should they be thinking about?
Yeah, well, Dave touched on it there. I mean, like, diversification is the key in terms of managing risk. So what you don't want to do is sort of just concentrate yourself on one stock or two stocks or one property or something like that. You want to be diversified. You want to be diversified in regulated investments as well. You want the protection of good regulated products.
And what does that mean? Regulation. Regulated.
The Central Bank of Ireland, being the regulator, has looked at these things and said, they pass a certain sort of quality test almost. Unfortunately, quite a number of people have been burned by unregulated investments over recent years as well, and going back over the last 10, 15 years. Mm-hmm. So regulated investments are key. Being diversified. Also thinking about, how much risk are you comfortable taking? So again, back to that blend of bonds and fixed income and equities and cash and maybe infrastructure, some listed real estate. Also in Ireland specifically, if you're talking about investing outside of a pension, then you're entering into a very complicated world of taxation, and you do want to proceed with a lot of caution, and that would speak to almost certainly taking advice. I mean, generally, I would suggest most people should seek professional advice when it comes to investing, but very specifically when it comes to the tax on investments, that can get very complicated very quickly. Yeah. I
mean, one of the things that I often get pushed back on or question on is, not question on, but I present to clients as, don't invest in anything you don't understand. Yeah. So, crypto, most people don't understand crypto, and in actual fact, and this kind of a conversation is kind of hard to avoid, is property, but we'll come to that in a minute. But I mean, people generally don't understand a lot of these things, and these, big returns for low risk, all this kind of stuff is a load of nonsense. But
if it sounds too good to be true, it probably is. Realistic expectations are a really crucial thing as an investor as well, because if you have unrealistic expectations of being able to make lots of money by taking very little risk, then you're probably going to be disappointed, and you're probably going to end up doing things which aren't helpful, like jumping in and out of the market and trying to time things, and that's really proven not to work for the vast majority of people.
Look, these kind of conversations, and it is Ireland because we have a love of bricks and mortar, let's face it, right? So, but people often misunderstand what property investing is, right? They don't understand it. They think, I'll invest in that property down the road, I'll get a nice rent roll, happy days, it'll be paid off over 20 years. I suppose, Dave, if you're considering investing in property, what are the things you should consider?
Well, I suppose
pros and cons.
Pros and cons. Yeah. I suppose understanding property and understanding that there's risk associated with property, and I think the Irish psyche sees property like a deposit product until such time as 2008, when we had the credit crunch and people saw that their property was falling in value. They couldn't really understand it. They never associate risk with property. The major things with property, I suppose, that stand out to me when people, you talked about rent roll. You tell me, you say a rent roll, I said I say landlords are exiting the market because the tax is very high. They don't factor that in.
That's the big
They
one.
factor in a rent roll of 20 grand a year, but then you take the tax out of it, the return that you do to your accountant, the management costs, so on and so forth. And then they've borrowed money and you've got the high interest rates we have at the moment, and all of a sudden there's a shortfall. Oh, I didn't, that. The other side of it is with property, I suppose it's an illiquid asset. So we always love to think that we can invest long term. Properties are normally, especially in the current market, rather large investment structures. So you are tying up a lot of most people's capital if you buy a standard house and rent it out. A lot of people will think that property, they'll look at the recent cycle that we've just had in property, and people would say, let's take in 2012, which seemed to be the perfect time to buy a property. If you had bought a property in 2012 at the bottom of the Irish market and you held it and you had that cycle of growth to present date, would you have been better off putting your money into the collapsed stock market? And the answer is probably times 2, right? So you would have made double the money. And most people would never have, so you have to point these things out to clients.
People think they understand the property investment. That's generally the problem, and it's usually what leads to tears.
It always underperforms the equity market over the long term.
As well, people think property is a more stable asset than it possibly is in reality compared to the stock market. The stock market, when you think about it, is being priced, literally as we sit here, it's been priced second by second, minute by minute, day by day, whereas property is not. So it looks like a more stable value over time, but that's only because there isn't a price on the outside of every house that you walk past on a daily basis.
But property is really valued at the price somebody's willing to pay for it at that point in time. I mean, that's what drives it up. I mean, the current valuation, why are there so many properties for sale at the moment? Because we are at a point in time where they're going to get big value for money.
Yes.
And it is, as advisors, guys, would you recommend now's a good time to invest?
In property? No. I wouldn't personally invest in property now. I don't think the property is going to drop. But like you take even the performance of the stock market in the last 12 months. You don't really hear that in the news. No. I think property went up by something like 3% in the last 12 months. I'd say the stock market has grown by 5%. But it's because it's now cycles change and stuff like that. Yeah, it's that understanding. But Irish people, I do believe, have what I always refer to is that see, touch and feel element to property. That I can see it, I can touch it, I can feel it. The stock market is...
Yeah, I remember the time...
almost fictional.
Irish investors were over in London saying, I invested in that building. 50 million euro building, and they were kind of rubbing it, that's part of mine. So it is that mindset. It's very difficult to get over, but sure, look guys, thanks a million. I suppose there's a lot to consider here. For most people, it's quite a challenge, and it's filled with problems. It's filled with landmines, a lot of stuff to consider. It's very easy to make a lot of mistakes. I suppose if I was to sum up what you guys were saying, I suppose this is, educate yourself. Do a little bit of research, look into it. Don't just accept that your mate down the street bought a property 2 years ago and is now, massive assets. You should also speak to a trusted peer or family member, somebody who has done it for you in advance, I would say. Yeah. They're somebody you can trust, and then really ultimately the best way, in the longer term, I suppose we can't really argue is that the best way to get proper long-term advice is to seek the advice of an advisor, a trusted professional, to help you guide and ultimately make those decisions. Anyway, thanks very much, guys. Appreciate it.
Thanks for coming on.